Okay. All right. Good morning, everyone. Thank you very much for joining. So I think for today's discussion, right, we will just quickly talk about this Snowflake first, because Gavin actually reached out to me and mentioned that, okay, because past week there are a couple of earning release, right? Then I think it's fun also to talk about it. And then I think we can just start with Snowflake, and then if there's any other companies that you guys are interested to share or discuss about, you can just unmute and then we can discuss. And then maybe after that, we will just talk about a couple of questions that was discussed yesterday morning. Then we go to Slido. So I will always give priority to those that style in. And not just submitting questions on Slido. And on those who submit questions on Slido, right, I think I will also give priority to those who left their names in Slido instead of like asking questions as an anonymous. So I think, yeah, I'm actually sharing the screen here. So I'm pulling up the earning release, and also this is the Investor Day presentation. And this is the earning release that just came out, I think last week, right? So I'll just pause here and just pass it to Gavin for opening statement. Okay.
Actually, I don't really have an opening statement, but I saw quite a lot of people talking about it because the stock dropped a lot. And I think the stock drop is very, very unprecedented. Like there is no big fundamental reason as to why it dropped. There's only I will call it noise that's causing the drop because of the guidance, and then analysts weren't happy with the guidance. So there was a lot of, I would say, misguided noise. Yeah lah.
Yeah. Okay. But before we start, right, let's talk about, I think, because I don't think everyone is familiar with these companies. So let me just give like a very brief summary of what this company is based on my reading in the past. So I know that this companies is considered data management companies. So when it comes to data, I don't think it is just like those in how to say, it's not just structured data, but they can also help with the management of unstructured data. So any companies that use data, right, can use their services. But what is different about this company is that they are cloud first, right? So they don't have, meaning that their customer that using their services, they don't have to maintain their servers. Everything will be just on the cloud. And then they, compared to other competitors, they are very good in terms of the user friendliness. So this is also based on some of the customer feedback and comments, basically. So this is something about it, because when you are using the cloud, right, there are a lot of advantages. For example, like in terms of scalability, is also much better compared to those that is non-cloud services. So I think this is also a very important point. And then because of the product is very superior, and they are still early in the growing phase, that's why we see that the growth rate, right, since not just since IPO, we're talking about like in the past 2 or 3 years, you look at their growth rate is still very high. This is where they, in the past, I think this company is also, it's not like just set up like 2 or 3 years ago. It was like quite some time. I think, I don't recall exactly, but maybe like even 10 years or so, right? So in the first, they just focus on building their products, and then now they are at the scaling phase. And it's quite impressive, right? If you look at the financial highlights, they are growing at like 102% year on year. And then their net revenue retention is also very high. I think these are the good part. But I think since their IPO, the problem is always with the valuations, because there's no earnings at the moment. And even if you look at the price over sales, it's still crazily high, right? Even after the price drop, right? So yeah, I'll just stop here just to hear some comment, because I know Boonsong also discussed with me like in back and forth in the chat group before, right? Talking about like, okay, these companies, they are too richly valued. So when you see like 20, 30, 40% drop in price, this is quite normal because it may price at a not sustainable basis before this. So I'll just pause here just to hear some any comment. So no comment. Just want to ask, Gavin, when you look at these numbers, right, what's your impression?
Very good, eh? Like, to me, the net retention is a very big factor that I'm looking at, because you want customers to be spending more over time. And if you look at the results, their net revenue retention is actually increasing quarter over quarter, which is very, very amazing. Yeah. As for product revenue growth, right, it's still good that it's doubling year over year, but it comes to a point where, because of size, right? If let's say you have $1 today, it's very easy to double it into $2. But let's say you have $1,000, it's harder to double because you need another $1,000. So it's very unrealistic to assume that to assume that Snowflake will continue to grow doubling each year all the way down, because it's very, very unrealistic. Because when they IPO, the revenue numbers were a lot smaller, so it was easy for them to more than double. But now they are reaching quite a sizable amount with the revenue. If I'm not wrong, it's 1.2 billion for this financial year. So it's very hard for you to double again from 1 billion onwards. Yeah.
They're guiding for like 60% growth, right, for this year.
Yeah, their midpoint is 66%, which is still very high, honestly.
Yeah.
What are the competitors? Sorry, Bunti. Go ahead.
Go ahead.
Okay. May I know what are the competitors of Snowflake, and what is so special about Snowflake in a short statement?
Okay, for Snowflake, I think the very generic or easiest way to say is that its competitors are its own. So Snowflake's platform is built using GCP, AWS, and Azure. So whatever that it's running on, so that its infra is also its own competitors, because Google has BigQuery, AWS has Redshift, and then Azure has Synapse. So his Snowflake is fighting against the big three, which is very unfavorable in this sense. But I've done a quick comparison across the board, and I'll just do a quick summary, which is when Snowflake is compared with BigQuery, which is GCP's solution, BigQuery is actually cheaper, and it has slightly better security. So it's better than Snowflake in this aspect. As for other functionality and performance and architecture, it's around the same. So if you're a consumer, you will go for BigQuery because of cost and security. Next will be Redshift, which is AWS. And then for this one, Snowflake actually wins by a bit on pricing model. Security and performance-wise is around the same. So, and then we move on to Synapse, which is Azure's solution. And then it's roughly a tie as well. So Snowflake versus all these three, it's really around the same. And it comes down to your usage, how much you need to scale. And then based on that, perhaps you can spend lesser depending, right? But one interesting factor to me is that if you want to integrate data from, let's say you have data points across GCP, Azure, and AWS, right? So Snowflake allows you to easily integrate all these three from three different data points into the platform itself, rather than, let's say, if you're running on Redshift and then you need data from GCP, etc., it will be slightly harder to integrate. Not saying it's impossible, but Snowflake gives you the ease of integrating all of these together. So that's one interesting point that I would say is a winning factor for Snowflake as compared to using some of its competitors. But product-wise, it's roughly the same.
Am I understanding this correctly, that Snowflake has to build upon on GCP and Azure? And also, how does this compare to what Palantir has to offer? Okay,
so the Palantir one is, so Snowflake isn't a SaaS. So Palantir is a SaaS, right? Software as a service. So it's offering software. So for Snowflake, it's actually a PaaS, which is platform as a service. So you can see in all the presentation slides, they like to start off with Snowflake is not a SaaS. which is very true because it's a platform. So that's the big difference, and that's the like very simple one-line clear-cut difference between the two. Snowflake is a data warehouse, right? So they let you manage and use your data in interesting ways where you based on your business needs. So as for building upon the big three cloud service providers, think of it as this. So Snowflake is using these three cloud service providers as their cloud servers, and then they're just building a layer on top of that for customers to use. So the infra layer is still handled by the GCP, Azure, and AWS, and then for the platform layer is Snowflake, and then the customer has the flexibility of customizing from there.
Yeah, I think this one is quite interesting because actually when I first thought about Snowflake, there are friends that reach out to me and then just say that actually Snowflake is not too different compared to Redshift and also, like the BigQuery. So that in terms of the product, they are not too different. So there's no mode. I think that's the most common argument against Snowflake. So, but if you look at it from a customer perspective, right, I think there's this saying, for example, like if you are, do you actually want to use Snowflake or let's say Redshift, right? So I think the argument is that if you build everything on AWS and you use all the software that is from AWS, then you might just want to use Redshift because everything is better integrated within the AWS ecosystem. But let's say if you don't want to like rely too much on AWS because when you put on too much reliance on them, right, then they can screw you up anytime they want. So there's always this risk, right? Even though their services, everything is also quite good. So by using Snowflake, you can actually help you mitigate this risk. Because when you are using Snowflake on the top layer, you are actually engaging with Snowflake, and then on the back end, for example, when Snowflake, they can actually choose AWS or they can move to GCP. But that's the other layer. You don't have to care so much about that. You just deal with Snowflake only. And that actually reduce the reliance to these big three cloud companies now. So that there's some advantage of using Snowflake and not Redshift, which is not on the product considerations. It is like what kind of relationship that you are having now. I think this is also something that's quite interesting. And come back to the cost, right? Also, it's not something that can be easily it's not easily comparable because when it comes to data, right, there are like storage costs and then there's compute costs, different type of costs now. So it is not so straightforward to say, okay, if you are using Redshift or you are using Snowflake, it will be cheaper or more expensive. Sometimes, depending on how you use it, depending on what's your requirement, the cost will vary. And sometimes using Snowflake could be cheaper, and then sometimes using other alternatives could be cheaper. So it's a bit hard to generalize. But I think in terms of cost, there are not like a very big difference if you compare all this. And then actually, just shift gear a bit. I just want to ask, Gavin, you mentioned about this, how they recognize the revenue, right? So they are like, first, I know they are like buying credits, and then the customer use the credits, and then it will recognize as revenues, right? Compared to any other companies, right? What's the difference or anything special about this type of revenue recognitions? Can you elaborate a bit on this?
I don't think it's a big issue. It's just something to take note that revenue is only recognized when it's being consumed, right? When the credits are being consumed. So customers can buy in big chunk and then slowly consume over time, and then something like that. So it's not a very big issue or anything to me. It's just something interesting that I realized. Yeah.
This is consistent accounting alarm.
Yep.
Actually, what is it? I think this is about data consumption. Another point is that they are. It's like similar to the Twilio. It's like, okay, they don't charge per license, but they charge per usage. I think it's come back to like, okay, they actually charge based on the compute and storage, right? So what Snowflake want to do is that they don't want companies to continue with the old ways of doing things, meaning that companies maintain their server in-house and then everything, all the security, all the updates, you have to do it yourself. But they want you to build your entire companies, all the data actually built on top of these platforms, right? They're Snowflake platforms. And then once your business is actually built inside their ecosystem or their platforms, right? Then as your business continue to scale, then you will actually pay more to them. So that's how they increase their all this revenue over time also, right? I think this is something that is quite interesting with companies like Snowflake, because they actually don't need to like really get a lot more customers. They just need the customers to grow, and then as they grow, the revenues all will keep on increasing.
Are there any case studies that we can look deeper into, and also maybe like if there are any case studies we can see how what is the how do I put it? Is there any comparison between, let's say, studies that show someone using Snowflake and someone not using Snowflake, and what are the advantages and disadvantages that are listed out? And also, the third question is what kind of effort would it be needed to migrate? Let's say if I don't want to use Snowflake, I want to bring it totally in-house and do the same thing. What kind of effort will there be? I'm not sure if you have any info, but just any case studies or any flagship use case that we can go and search.
I think you can. Okay, as for the case studies one, right? I think there are a lot of blogs and websites and articles that write from a developer's point of view after using Snowflake versus its competitor product. So you can read into those and then sort of draw your conclusion from there. As for what was your last question?
Any like flagship use case that you can just simply elaborate? What kind of use case to people have to use this instead of not instead, what kind of use case do people have when they use Snowflake?
For one thing is there's no like clear mode. So whatever that Snowflake allows you to do, to a certain extent, you can do it in-house, right? But it comes down to saving time and cost. Do you really want to spend so much money to hire a team to build something in-house that's going to take at least a year or two based on your needs and wants, versus just spending maybe a quarter of that cost and then you have a product ready to go? So there isn't a clear mode as to what it does. I'm pretty sure big tech companies could build something similar in-house, but it comes down to time and cost, which is the factor between just building it or just using Snowflake.
Okay, so that means, from what I understand, is that it boils down to whether like in the past, where instead of hosting a website yourself, you host it on the cloud, and also maybe depends on the organization on whether they want to invest in their own infrastructure rather than going to the like AWS and so on. Is that what I'm? Is that correct?
A simplified explanation, yeah, something like that.
Yeah, I think for example, like talking about how they use data, we just take a bank for example. Like right now, I think many banks they are still using their own infrastructure, right? They don't actually operate on the cloud, and even for those banks that operate on the cloud, they are now in the transition phase where slowly more and more like all these workloads will be performed at the cloud. Because I think the way towards cloud, right, is for sure is like that's the superior way. Because if you know that, let's say you need to run something and then within short period of time you need a lot of compute, right? If everything you use your own hardware, then you need to keep on buying a lot of hardware, which is very expensive. It's not scalable. So all this new way of doing business, whereby everything is on the internet, everything is online, everything is done by the customer themselves, you really need a good infrastructure to actually support this kind of business that is online all the time. So I think for the companies that we have, I also don't think there are many companies that like cloud first kind of way of doing business. So we don't see like at least for me personally, I don't know like is there any like big profile high profile companies that is using Snowflake. But this is also because they are still early in the phase, right? They are still growing. So the total addressable market is definitely very big. But what I'm saying is that I think as companies recognize that they have to build things on the cloud, right? Is it superior to do it like they just do this with the AWS, with Azure, with GCP, or does it make sense to have another layer, which is Snowflake in between, so that, okay, like the one that I mentioned, they can reduce the reliance, and also based on some case studies that they are very user-friendly in terms of the software that they provide. Everything is on the cloud. Yeah.
Another interesting point I want to bring up is that why some companies would not want to have over-reliance on one cloud service provider, right? So AWS is very known for very, very cheap storage, right? The S3 is very, very cheap. But once you scale up to a certain size, it becomes very, very expensive. And you would think to yourself, okay, I can just migrate some of the data out. But it comes to a point where the data is so huge that it will take, I would say, easily weeks or months to move and migrate out the data. So you are kind of stuck in a very sticky situation where you have to just keep paying the high fees because it's going to take so much more cost to migrate out the data. So one workaround would obviously to be spreading across your data across different cloud service providers, not just for availability, but also to lower cost, right? So Snowflake will let you have ease of mind if you do that. So it's just one centralized area for you to just collect all the data points and then do whatever you need to do, because Snowflake is not just collating data and then that's it. There are still some features and tools with the platform itself that will let you do interesting things like data analysis, so on and so forth. So it's not just collecting data and then bundling it up and then just giving it to you, but there's also like built-in features and tools that you can use together with the data. Yeah.
Yeah, another, before we move on to the valuations, right? Another things that I want to mention is this data cloud things, because like I just draw it from my own experience, because right now, right, the way we do things is that, okay, everything we store in our company server, right? So that's where it is stored, and the analysis is also done on premises, and then we also have a lot of data that coming from other places. So for example, like we have a connection to, could be anything, right? It could be FactSet or Bloomberg or Reuters. You just get the data and then you put into your analysis, and then we do our monthly reporting, quarterly reporting, this kind of way. But I mean, with all this analysis nowadays, monthly or even quarterly data doesn't make sense anymore. There are a lot of things. I mean, the superior way is you have to make it become real time, right? Things need to be updated automatically. But the question is, how do you do this without the cloud, right? Because basically, if you have to do it manually, you have to like download data from here, pack it inside, save in the folder, and then do the link, the refresh. You can automate the linkage process, but it just won't become like real time automatically. So to do that, to make it become true real time, automatically updated, right? You really need to bring everything to the cloud. So instead of like storing your data or your analysis on premises, right? You need to store it on the data. And then the next question is, once it's on the cloud, right? How do you actually link it to another source of data providers? Then this is where this data cloud will come in. I mean, based on what's Snowflake roadmap is that, okay, now your stuff is already in the cloud, and then they will try to get the data providers, for example, like all these Bloomberg, they should also park their data on the cloud, right? So once their data on the cloud, they can actually sell their data in the forms of subscription or like there's many way of they can share it. But basically, if this is also on their platforms, right, and the customer is also on their platforms, right, then it's just a matter of like open up the door and then you can access to their data immediately. And then because they are all in the same server already, right? So all this, there's no more latency problem. Data can just shared among companies like in a very quick manner and very easy manner. And then not just that, right? Because you as the customer, you also collect the data, right? So some of this data that you collected, right, might be useful for other companies. So other companies or other people, they might willing to pay sum of money to access to the data that you collecting, right? So in that sense, you can actually also just monetize the data that you have. Okay, of course, it needs to be legal. So I think what they try to do is that, okay, first they make the platform very user friendly. Next thing, they want to like get as many customers as possible. Third, even the data providers has to be on the same platform. And then this is how it becomes like a network effect moving forwards. So this is something that is, as of now, not much visibility. Actually, I don't see they report a lot of things with these data cloud things. But let's say if this thing becomes true, right, then I see there's a lot of potential, because what happened is that it becomes like a platform where data just flow around, right? And then they just need to like charge a very small percentage of fee for all this. It's not like a fee anymore. It becomes like a tax, right, for all this data moving around. But when this data moving around, there is actually not much cost also, because everything is on their cloud infrastructure already. So I think this is something that's quite interesting. Just share on top of my mind. Any other questions or any questions that you guys or any comment you guys want to make? If not, we will just quickly jump into valuations. And I hope that is Boonsong still here, because Boonsong also mentioned about the valuation. I think worth to talk about it now. I just pause a moment, see any questions on.
How do you all get exposed to Snowflake? Like just how you all come across it?
I came across it via IPO, and then, like it's quite high profile also, right? When they IPO, Berkshire also invested, and then Salesforce also invested in them. I mean, all the data that I have is all like all this online S1 filing and so on. I haven't know anyone that use it. It's just that from some YouTube video, there are people who mention that they know someone who are the users. And just a very generic comment is that they are quite famous with the user friendliness. Other than that, I don't know a lot of the first-hand kind of experience.
So anyone has first-hand experience on using Snowflake, or their company is using it, or they have seen it being used or anything like that?
No.
Yeah. So I did came across and with their sales, and they try to sell, partnership with our company. So I think that why they were very successful at the front is that they can tap into multi-cloud, and they use the open source kind of source code so that it can generate queries really fast. I guess that's lacking previously, especially on the analytics platform now. And yeah, so I guess the multi-cloud and the multi-source that you can come into this so-called previously they were called data lake, but now they call it data cloud. So it's kind of like you merge all the data and you flow into one big chunk of this cloud, and you do analysis and you dissect, and that's what all the analysts like to do. I guess now, like AWS, Google, and all this, they know this is a very lucrative area, so they try to cut them off now. So yeah, so they might face a very tense competition. But firsthand when I saw them like 5-6 years back, they are very good and very cheap. So actually, there's a lot of banks, local banks, who did some tryout. I think they sell successfully in the local banks also in a small scale. Yeah.
Thank you.
Also, for myself, I was looking for a platform as a service to invest in because there wasn't many. Then came across Snowflake, and then just nice they just filed the IPO. So I dig very deep into it. I even went to sign up for all their whatever online workshops and whatever just to see how the product really is, and it's quite interesting. And they are really aggressive. They send me like emails every other week to join their workshops to see how to better utilize their product. So it's quite interesting. I joined a few just to really see how the product is being used. I would say for me, from what I see, it's quite easy to use. There isn't a lot of very cheap understanding. It's very easy to use, very user-friendly. So, and the sales team is quite aggressive, I would say, or rather, they just keep sending a lot of emails to join workshops to help customers better use the platform, which is great. Yeah.
That's good.
So I want to ask Billions Achiever, have your companies, finally decided to get on board on Snowflake, or just like forget about it?
No, my company does not use it, but we are kind of like a partner to sell it. So they try to partner with us to sell it to others. Yeah, so I think we did some trial projects with some of the companies. Yeah, but after I left the company, so I do not know what happened. Yeah.
Oh, okay. So you don't know whether it is still ongoing now, or is it like...
I'm sure they partner with other companies like IBM and all those big like Fujitsu, all those big huge firms that they can use them to integrate into their whole solutions to sell, which I do not doubt their capabilities. They have a very good products from IT perspective in terms of data platform. 5 years back, I have not seen this type of products and solutions before. It's quite interesting and quite new. But I think after 5-6 years later, I think other competitors already catching up, especially those really rich competitors like Google, Amazon, Alibaba, and all this. They can really slash and say, if you buy my license, I bundle this as like almost free. Yeah, so it can really kill their business like that.
Yeah, interesting. We have very big competitors indeed. Okay, I'll just stop here and then let's talk about a bit on the valuations because, these companies, I recall last time price over sales was 70 or so, right? So it's like crazily expensive, right? So that's why I only invest like very, very small amount. Not comfortable because of the high valuations, right? But I just want to bring to this attention on like their, this is the page that I'm looking at now because I don't know like how soon they will turn profitable. But if you just look at, this is presented by them last year in their investor days. So they have this like financial year 29 targets, right? Which is like, like 8 years from now. And they're saying that they will reach like 10 billion revenue and then with a free cash flow of 15%, right? So we're talking about like, okay, after 7, 8, 9 years, they might able to generate a cash flow of like 1.5 billion. So I think this is, I don't know, if you look at 1.5 billion and slap it with like a price over earning of 40 or 50, right? You still get something like a valuations of say, don't know what, 70 billions, kind of level. It's not, it won't reach like 200, 300 kind of valuations, right? And then you still need to discount back, right? So I think by just looking at this, still, even with the price drop, I don't think that's very cheap. So at least that's my impression. But we need to recognize that we are paying a premium because of the management and how they execute. So I'll just pause here just to hear any comment from Gavin or anyone else. On with regards to valuation, you can share how do you assess the valuation of these companies?
Okay, so for tech companies, I don't usually use things like free cash flow multiples or whatnot. I normally look at TAM. To me, total addressable market is very important, and your RPO or your annual recurring revenue, whatnot. Because if let's say if your total addressable market is $1,000 and you're making $100 revenue already, you already have 10% of the total market. So your growth potential is already limited versus if you only make $10, you have a huge room to grow. So that's why I put a lot of emphasis on total addressable market. So as of recently, Snowflake talked about their TAM and it was about 80 billion, 90 billion. So in perspective, in 10 years time, assuming if the TAM doesn't grow, they are going to be making more than 10% of the market share. But of course, we know that the whole data market is going to keep growing aggressively over the next 10 years. So I think they are judging this also based on the TAM that they have. And I think the TAM will grow to a huge number, perhaps even in the trillion numbers, because of how fast cloud and data is growing right now with AI and ML pushing all these things up. So I think it's a little far-fetched, but I think it's still possible for the revenue number, not talking about valuation-wise.
Yep. Thanks a lot. Any other one want to comment? What was I saw Kyith also here. So you want to comment a bit on the valuation? Have you looked at this company in details?
No comments.
Okay. Others? Boonsong? Okay, no comment. Okay, any other questions or anything, any aspects that you want to talk about?
Yeah, I was looking at Boonsong here. I was looking at Berkshire's price for Snowflake pre-IPO. If Google is right, I think their price for Snowflake was $120 per share. Currently,
they're going before the IPO jump price. That's why.
Yeah. So if this investment was made by probably not those two old men, but if they were made by these Tom Coates and Pat Westler, right?
Yeah, it's made by one of their generals.
Yeah, generous. Yeah, so they are not they are probably more forward thinking that the two of them. So if $120 makes sense to them, maybe 209 wouldn't make too much sense. That's my comment. And just now Bunti said that if their profits are going to be 1.5 billion, we're still looking at a pretty high market cap, 64 billion as of now. Yeah.
Yeah, it's not low for sure. But I think, I think something interesting about Warren Buffett and also Charlie Munger is that, even the Apple investments, right, they ramp up until it become like one of the five large business lines for Berkshire, right? But the first investment into Apple is also not done by Warren Buffett. I think it was done by also one of these two guys. And then after Warren Buffett warmed up to that as an investment, and then he put in like much bigger. Then for the BYD also, it's not Buffett's idea. I think it's also he borrowed from Munger, and then Munger borrowed from Lilu, something like that, right? So they are actually open to this kind of ideas, and then once they see something that has traction, right, then they add more into it. So as of now, I think this is still in their probation phase, meaning that they haven't really increased their stake into Snowflake, right? But then they also haven't sold it off. So I think there must be something that some factors that make them continue to hold on to this investment, right? Because not just Warren Buffett. Let's talk about Todd and Ted, right? They are also considered value investors, right? But they haven't sold it off, so I think there must be some reason. Maybe they are looking like way ahead and see the prospect of these companies. Okay, if there's no more questions, we close the discussion for Snowflake, and then let's move on to a couple of questions that Billions Achiever. Every time I just call your name, Billions Achiever, I was feeling quite funny. You want to like elaborate a bit more, especially if I don't think everyone here have read all the conversations in the group. You want to discuss a bit more in details on the question that you raised yesterday?
Yeah, so I was having a coffee with my friend. He's an investor himself, so we are just having some conversation together for the investment environment right now. So he said he's almost in cash and not really invested in the stock market. When I told him that I am 100% in stock market, he was really shocked. His logic reason why he was shocked is that he said, okay, now there's interest rate coming. So that means that the liquidity for cash is lesser. So he thinks that cash is more valuable in this sense. And he also mentioned about for long-term investing, it could be a chance of low returns in the stock market environment, especially for the index investing. I'm invested in SPY and Qs. So he was saying, it could be a lost decade because the boomers is going to retire soon, and there are more cash out than the millennials can put in for investment. And that imbalance itself for the cash coming out from the stock market can further impact the returns. That means that it will push down the price of all the companies as well as the indexes. So he mentioned that it is very dangerous for us to invest in this environment right now for the stock market. And he believed that investing in other things, especially holding cash, is safer. And he quoted, Warren Buffett, who have a lot of cash right now. He asked me, so why he have so much cash if the market is so good? So that's why I threw the question to the group. I think people are quite interested and have different school of thought. So I thought, why not have some discussion here?
Yeah, I think these are very good discussion. In fact, this type of discussion is not just like recent weeks, right? Let's say in the past 1 or 2 years or so, there's always this type of pointers that people mention about Buffett's cash pile. They mention about interest rate is low now, but will not stay low forever. I think these are very. I actually agree with the assessment. I won't say these are like have fun staying poor, that kind of things. So I think I actually agree. But curious to hear like other people's views. For example, anyone want to share your response or your comments?
I think I mentioned in the group already, but I was because when I first started investing, I watched every single Warren Buffett AGM, watched every CNBC interview. I watched. So I listened to him talk about the farmland analogy like 1,000 times at least. So the thing is, he's always said that if he could, he would be 100% invested because over the long term, the market will always go up, right? The reason why he has cash is because one, so you have some dry powder in case good opportunities comes up, right? The second is also because they have actual business to run. They're not just like a full investment firm. They still have the insurance line of business, which also requires some cash in case anything happens. So, Bunti screenshotted from the annual report, right, that the amount of cash that they actually have they would like it to be lower, right? And it's actually not a lot in terms of portfolio value, because everyone likes to look at it as, oh wow, Warren Buffett is holding billions of dollars in cash. But you need to think about it in perspective to his portfolio. It's actually not a very big portion. It's not even near 50%. It's I think it's about 30%. So he's just keeping cash for these two reasons, because now the market is on a huge correction. I think it's a good time for him to start collecting good deals on the way. Yeah.
Yeah, I think for Buffett also, the challenges that he's facing also very different, because he actually doesn't make sense for him to get into like small cap. Doesn't put it has to be like big enough for them to invest. Like, if not, the operational cost, right, by just monitoring all doesn't make sense.
Yeah, correct. Because I think he mentioned in a few AGMs back that if he had a smaller amount of money to manage, maybe 1 million or 10 million, it would be a lot easier for him to invest versus now, because of the number of opportunities he has now with his cash pile, or his like portfolio value is a lot smaller than what he had when he first started investing with a few million. So like you said, it's very hard for him to find good investment opportunities that they can put a sizable amount in, because let's say if you put it in a small cap, how much can you really put? And then what if you put a lot and then it's going to you might end up just buying over the whole company at the end.
Yeah, which they did. But let's say if we come back to these comments, right, there are a couple of big arguments, I think, which is valid one. I think number one is that, okay, valuation. I think the valuation topic has been discussed like, I don't know, like how many times already. Because it is true that if you look at the, let's say like all these total market cap over GDP, you look at Schiller PE, you look at any indicators are showing that market is not cheap now. Let's say 1 year ago is even more expensive, right? Because the earnings was still, we're showing, let's say like past 12 months, you are still showing the numbers that include the COVID period, 2020. So PE definitely looks high. Now it become lower a bit because earnings has increased and the price has came down a bit, right? But still, even with current recent drawdown, it's still not cheap, right? You just need to compare across like period, let's say in 2014, 2015. Those are period that is market much more cheaper. So I guess for those who have experience in the markets, for example, like 10, 20 years, right? They have seen the market peak in, let's say, 2016 and then crash in COVID. And then before that, it was like 2007 and 2008 market was high, and then it crashed in 2009. And then period before that also, they will see that these things move in cycle. And then if you try to see it from this lens, right, you will notice that actually now, like even 10% drawdown is still nothing, right? It could drop another 10% or even 15%. I think you still won't say that the market is cheap. Right now, I think the people who say, oh, drop 5-10% is cheap, right? I think these are the people who just started less than 5 years, right? They haven't seen 2009. So they don't know like how cheap could it be, right? So if you just look at like past 1 or 2 years, like every time market drawdown hit, let's say 10%, then it rebound back, right? And to you, 10% drop, it will be very cheap already. But historically speaking, it is not, right? For example, like Apple now is what, 160? It could drop to $80, right? Which still possible if you look at past history. They just need something like looks like recession. For example, like you have seen 3 quarters of revenue dropping. Then for sure the market will sell off like crazy, right? So that's why I don't want to say like, okay, to these people who hold a lot of cash, I won't say that they're just having fun putting money in bank deposit earning that 0.025%, right? So if there's a argument to say market is expensive, then just stay away. I think that's fine, right? It's just that you need to have a trigger to say at what level it is cheap for you. And then if it really hits that level, it looks ugly, but you still need to buy in. If not, there will be huge opportunity cost of staying away from the markets. Yeah.
I think another interesting school of thought is your age and how long of a runway you have. Because if you are, let's say, 20 this year versus your 60 this year, the way you invest is going to be very different because you don't have the long time horizon to wait for it to recover. So that's another interesting thing to think about also.
Yeah, definitely for sure.
Yeah, not to take sides, but I also totally understand what Billions Achievers' friend is coming from. But just to have more context, Billions Achiever, how old is your friend, if you are comfortable to share? And also, what size of portfolio does he have, or maybe roughly what is his net worth, and what is he like a ultra high net worth individual, or is he just an average person, or how would you categorize your friend?
He's about 40, early 40s, yeah. Currently just doing pure trading as his own free time. So he does not really need he's already FIRE already, yeah. So he have his own house and he's living in a very comfortable life. I would not say really high net worth, but comfortable life as I could see, yeah.
How long has he been in the investing, and what was he doing previously? If you are comfortable to share,
He was doing some. He was in the finance and institution tradings. Now, after that he left and he's doing his own tradings on his own. Yeah. So he's earning his income from his own tradings.
Okay, so thanks. Yeah, so that's why you see, if we know the context, right, we can see that this person is actually he's very macro view oriented, and he looks into because he's making money from this, right? So he knows he knows what he's doing, lah. But from my personal view, right, I think I would rather say invested, because not like say, I sometimes also people say like, all in is not actually really all in, because to a certain extent I still need to secure my living expenses, and also to make sure that my basic needs are sorted out. But some people would say that I'm afraid of the volatility, so selling off and then putting it in a safe cash or in a comparable liquidity is also not wrong. So I think it's all on a case-by-case basis. For me personally, I always have my from context also, I'm also in my I just turned 40, and I also don't have a day job, so I also invest. I do investing. I was an engineer, and so that's why I'm not sure how your friend is seeing this. Is he like 100% fully cash? Which I don't know. I also doubt that, because how is he going to, is he comfortable with just sitting on a cash pile for the next 5 or 10 years? So it's very hard to apply to everyone and say that, okay, the next 10 years is going to be stagnant or going down. I think we are always able to look for opportunities inside investments, even if you are not talking, say, like in the stock market. There are also other forms of investments. So I think we should have a certain percentage that we are comfortable with in investments, real estate or whatever, and not to go 100% cash, because if even like a normal person, if you have like 500,000 Sing dollars in cash, right, I somehow feel that that's really foolish to have that much in just cash. It's just my opinion, coming from I have 12 plus years in investing. So it's just not feasible to hold that much cash. I don't know what to do also. You just look at the cash pile, it's like very weird. and if you are not working also, it's like I personally don't feel comfortable just having cash.
I think it's a very different mindset, right? Because just now, Billion's Achiever also mentioned that her friend is someone like he is doing trading himself, so he's traders, right? I do see that those who have this trader mindset, right, versus those who has like investor mindset are very different. Because for investor mindset, right, what we want to think is that we are owning the business, and the business, as long as it's still running, as long as it has good management, revenue is still okay, earnings is still okay, then it's good to hold, right? Be it recession or revenue drop in certain quarter, as long as this is not something like a structural things, and then we are happy to hold, and we're happy to hold for a long period of times, right? Because we believe that as the company operate, then there will be profits, and the profits will get shared with the shareholders via dividends or share buyback, and then the share price will increase, right? So that's the investor perspective. But I also have some friends who is doing tradings, right? So trading, it's very different on how they look at stock prices or investing. Like they call it investing, but it's very different one. To them is that they don't have much how to say, they're not very loyal to certain companies. They will just look at the trend, and then they, based on some chart analysis or whatever, or some sentiment analysis, right? They just look at the trend, and they will feel that, okay, if this is a buy, right, they will just get in and then set some stop loss, and then if it play out, they continue to let it run, and then the moment it turn, right, then they cash out and they get good returns, right? And they might pay with some leverage to like just maximize the return a bit. So they are not happy to experience, let's say, 2 or 3 quarters of drop in revenue, and then which cause the sentiment down, that cause your stock price down, right? For traders, it's just like plain stupid to just hold this kind of companies. We can give a couple examples, right? Like yesterday, I shared the share price of Alibaba and also C Limited, right? You ask investor and you ask traders, right? They will give you a very, very like totally opposite opinion. For investor, they will just say, okay, they will try to anchor it to some fundamentals. It could be Alibaba, it could be C Limited, right? They will just say, okay, the GMV or the profits or the cash flow or the business, how much does it worth, and so on. They will anchor it to some intrinsic value and say that, okay, actually right now, whether the price is fair or whether it's cheap, and if it is cheap, then you would like to buy more, right? This kind of things is very common. This is investor mindset, right? You just ask any traders, right? They look at the chart, right? They will just say, it's falling knife. Why are you so stupid, and go and cash it, right? Which also makes sense if you think of it from a trader perspective. Trader will just say, okay, let the price drop first, let it run its course, and then once it finds its bottoms, right, and then you will see like a couple of candle, like a higher low, right? Then only you buy in, right? So this is very different, and that's why if you have traders talking with an investor, it's like chicken talking with duck. It's very, very hard to have a good conversation, because the mindset is all like totally different. So that's why I say if Billion's Achiever friends is like traders, right? I do see like 100% understand the perspective. Like this is not a market that you want to be in, regardless of how cheap it is, you know. You just want to get out first. And this comment is applicable to Alibaba, C, applicable to like QQQ and SPY as well. You just look at the chart, it doesn't look good. I think that's the one I will agree. Anyone else want to chip in on this? Yeah.
I think maybe it's also, I'm not sure, but maybe it's also like what the friend is actually taking a look at. I'm sure like not everyone wants to be in 100% cash, because that's also a problem. Sometimes, and even traders, they will prefer to hold some longer term position, so that they don't have to think about it so much. So it might be the case that if from what he sees, when all these things, a lot of things add up together, right? It necessitates something like that. So I'm not sure whether like that's the angle that he's not always like this super bearish at 100% in cash, but it's more like maybe the bigger thing is actually discussing like his views about like why is the situation so bad. And I think those things I heard before already, and it's, and in a certain sense, like, I don't have a clear answer firstly, where to actually refute those things. So which makes things quite uneasy in a certain sense. Like there are certain long-term trends. Like the liquidity is a big thing. The money flowing into managed investments, ETFs and all, is one thing. And if it flows out the other way, what will happen? Because essentially, if you look at their retirement accounts, like every time the market goes down, there is like an automatic buy the dip every time in their 401k accounts, in their retirement accounts, that consistently buys these things. So it acts as a support and all that. So I can see where it's coming from. Whether I have a clear answer or not, I don't have a clear answer.
So how you position your portfolio now, Kyith? Are you like between like 0% cash versus 100% cash? Where are you now, and why is it?
Investor law, about 70% investor law. Looking to continue to invest law. Yeah.
Okay.
In a certain sense, some of these things we're not sure like how long it's gonna play out, because like the part about the baby boomer thing, like that they're starting to sell, like I'm not sure like how clear of a sign that is. But it's also like I've been in that position before where you're in a large chunk of cash, right? And the other problem is thinking about when to invest and what to invest, and sometimes you also don't want to have that problem. So in a certain sense, I think some of the financial planning things does help that you have to understand which hat you're wearing sometimes, whether you're wearing the investment portfolio hat or the financial planning hat. And for some people, maybe it makes sense to actually sit out. For some people, probably not, depending on the situation. Because like maybe for her friend, right, it might be the case that for the last 3 years, right, he has been making above average thing, and that's actually enough for him to actually live his life. So is it quite senseless to actually sit out for 1 year and then see how things played out? Maybe it's okay for him, but for some people, maybe not so much. So from the financial planning perspective, like those people that is, I think, in the 38-year-old to the 50-year-old, that's I think the challenging age to actually live with, because your wealth have accumulated to a certain level already. And then when these things come along, right, like you're not sure like how long of a accumulation runway you have. It's always a moving thing, because if, let's say, for example, you have a .com bubble again, and then your 700k portfolio suddenly becomes 1.4 mil, then you hit your goal already if you continue to invest, and then but a lot of things can actually change. So there is that behavioral part to actually deal with, but it's also there's, for a lot of times, I think there's a lot of reasons to keep part of it invested, because it's a bit of humility, like you don't really know everything. Like sometimes some of these things that people put out there, like it can be quite obvious and all that, but what if things are different? Yeah,
true. I think these are not just 100% about what is objective, right? Like stuff we talk about, like all this interest rate high, all this like valuation, Schiller PE. These are objective stuff, right? Everyone looking at the same thing, but they are this individual circumstances part that we are not aware of, right? Like the one that you mentioned. If I have $5 million now, I think I'm perfectly happy to just put it in cash because, like regardless of, I just need a 0% return. I can still retire well, right? If I have like tons of monies, right? So I think need to put that into consideration as well. Okay, I just look around, see anyone else want to comment, or Billions Achiever, do you have any other points that you want to share and get some opinions? If not, we will just move to Slido. I just want to check.
No. I think it's a good discussion, yeah.
Yeah, we can, of course, continue this discussion, let's say in the coming weeks, if there's more information. And please, on behalf of the group, please extend the invitation to your friend. If he's happy to join our session, then it will be great, right? Then we can hear more perspective and he can elaborate more on his points, right? So let's do that. Okay, let's go through the Slido questions. If you have any things you want to share, please unmute and share. So I will just read out the questions. My dad passed me to $10,000 to manage. Should I put it in stable coins earning 8 to 12%, S&P 500 or QQQ or elsewhere? Thoughts and suggestion. What would you do? This is more like an open-ended questions, but it is interesting questions. Anyone else want to give your comment? Keith? Gavin?
I think the day is... Oh, yeah, you want to speak first?
I'll go first. I feel that your dad need to manage the expectations first. You need to manage your dad's expectations first. It depends on, is this money that your dad gives you as a gift, or is it your dad expects a certain amount of return? So you need to manage that expectation first, and then only you could start to consider what kind of asset classes to manage it in, because it's not feasible to promise the world and your dad suddenly cannot accept a certain amount of loss. So I think that's what you need to start first. But if this is a gift from your dad, right, it's your own money, right, then you can decide for yourself, because because I believe when you join this group, you know that there are so many opportunities that you can choose, right? Different kinds of risks, different kinds of rewards. So then you can go along that path and find what are you comfortable with, and then you invest that money.
Thanks, Kelvin.
Kelvin? Yeah, Kelvin said exactly what I wanted to say. But on the where to put fund, right, I think a lot of people always get lured into the high yield that crypto can always give, be it stable coins or anchor protocol or liquidity pools or whatnot. But easy money come fast and go fast also. So it's very important for you to understand why is there such a high yield and understand the risk. Because even though stable coins are supposedly giving you risk-free 12% per annum, it's not exactly risk-free. There is always a risk. If not, everyone will be a billionaire by now.
Yeah, nothing further to add.
Okay.
Kelvin said everything. Yeah.
Yeah, I think those are good suggestions. I just want to add that I think this is don't make it just become like a return or like how to grow this $10,000 kind of things. If I'm investing my own monies, right, I don't need to answer to anyone, right? Then I'll just do whatever I think that is the best thing. But let's say if this become like not just me personal things, right, become like a relationship between myself and my dad, right? So I think it's also good to go through these communications. For example, like you might want to draft up something, just put a page of paper to see, okay, actually, let's talk about what is the objective of this whole thing, right? It could be like Kelvin mentioned, it is a gift, and then then how am I going to manage this money? So what's the objective? Just list down it, just put it on the paper to say, okay, let's all agree on what is the objective, and then what's the risk that we are all comfortable with. I mean, it's all about like how to manage the expectations. Then it's good to put it on writing so that everyone is on the same page. And then from there, you can explore from top to bottom, right? For example, don't straight away go to talk about QQQ. You might want to say, okay, what are the available asset class, right? Because you start from top. Does it make sense to put in other places, right? Like what about gold? What about commodities? What about risk investment, which is I would consider as real estate. So start from the top, like asset class, and then from the asset class, you want to figure out, right, within this asset class, what will be the default investment. For example, like if you say this is equity, the default could it be like S&P 500? But you also need to realize that S&P 500 is 100% US, right? Then you might want to ask, like, does it make sense to invest globally, some VWRA, or do I want to invest in emerging market ETF, and why, right? I mean, putting the why is very, very important, right? So you might want to start with this kind of thought process, and then only go to the execution part, right? Like how am I going to deploy it? Should I deploy it at one go, or is it like 1,000 every month and deploy it over next 10 months, right? These kind of things. And then also don't just stop there, stop at the 10,000, right? And you want to ask like what's in the future, right? Because I don't know the profile of the person asking this question. If you're a student, you don't have income, then it could be the situation up until you have earnings and then you put more money in, right? But if you have your own income and saving, how are you going to take this as a start? And then how are you going to combine it with the saving that you have in the future, right? What kind of saving rate that you are targeting? How much you plan to put into this portfolio versus some cash? And that cash also for what other objectives that you have, right? Make it become more comprehensive. I think this one is a very big topics, very broad topics. And once you go through all the questions, right, it becomes like a handbook for you to manage your personal finance and your investment moving forward. Don't just think, and then you forget about it. Put it on paper will be a good suggestion. Anyone else want to share on this? If not, we move to the next question. Okay, no, let's move. Just like I promised, I will give priority to those who ask question with the name. So let's jump a bit here. And just now we touch on this staking, and also, this, we're talking about this. Yeah, I deleted already. The staking parts, right? So there's one related questions here from Fu. Anchor Luna 19.5%, Holdnaut 12.7% offering interest rate, IBKR USD loan fee 2.58%. Like that loan and put into Anchor or Holdnaut like a good earnings. I'll just point this question to Gavin. I think you have some opinion with regards to this staking investment, right? You want to elaborate on this?
I think end of the day, if everything is so easy, then everyone will be billionaire, right? But there is inherent risk that you need to understand before doing this, because on paper it seems like a very nice happy ending. You just borrow at 2.5% and then you put into Anchor protocol and then you earn the net 17% and then you'll be a billionaire in 1 year's time. But there's a lot of risk that you need to understand. And what if the when you need to make some form of repayment every month and then just straight that month your investment gets a huge drawdown in price, or you might even get rug pulled, then what's your backup plan? Are you going to file bankruptcy? Or it's very important to understand the risk. Then from there you determine whether the reward is worth taking this risk lah.
Yeah. Definitely true. Need to do due diligence. But my personal view, right, I don't know much about Anchor Luna things, but for Holdnaut, I think this is not just like free monies, right? You actually, there's this credit risk associated with this investment, because on the back end, you actually don't know how they reinvest, because they are paying you 12.7%, right? Who is actually paying them like more than 12.7% in order for it to become sustainable, right? So I know there are a lot of arguments to say, okay, because there are people who want to do short selling, then they need to borrow the coins, and they are willing to pay it, right? But then the question is always like, okay, if other people are paying them 12.7%, right? Then how are they going to make this 12.7%, right? Because there must be something that is like someone has to be making a lot more in order for these flows to become sustainable, right? And this one I think is a bit hard to actually know, because this is like a bit of black box in my opinions, because it's not so transparent on how all these are moving. So I personally is a bit skeptical on this like 12.7%. Definitely it's not a free money in my opinions. Yeah, but I don't know much about all this, so I just keep it short. Just look around. Anyone want to I don't know if anyone has done any due diligence on Anchor Luna. Do you want to explain how do they actually generate like 19.5%? This is quite interesting, right? Like free money. And it's pegged to USD also, right? So it's not like they can just dilute their coins. It's not so easy, right? How do they actually make this return? No one able to explain this. It's okay. I think people here are not able to explain this. Doesn't mean that it is not explainable. There could be reasons, there could be ways they can generate more than 20% in order to pay 19.5%, right? So, but yeah, I think my default assumption is that do the due diligence first, and also you need to answer these very important questions, right? If 19.5% is true, then why are the very sophisticated investor, for example, like hedge funds, right? Why are they not in here? Because it sounds like free money, right? Those who have billions and billions of dollars, right? Why not they just offer like, okay, actually you don't have to take money from all these retails. I'll just lend you my monies. I don't need 19.5. You just give me 18%. It's good enough, right? So they can actually take up all this business, right? Why are they giving this opportunity to the retail investor, right? And they have basically huge fundings, right? Yeah. Keith, you want to say something?
I think maybe 50% of it comes from the lending. Then the other people borrowing on the platform. The other 50%, I cannot remember how it come about already, whether it's incentives or something. Like in the near recent history of I think this, right? I think they did face some uncertainty, like whether that 19% can sustain or not, because I'm not sure, like, is it because people are not like borrowing as much or not. So essentially, I think one of the big word actually like actually inject confidence into it. So yeah, that's some of the background. Basically, it's like I also don't have a very clear idea there.
I told Boon that I know someone who is active in the Luna, and he seems to know quite a bit. He has a deep knowledge. So hopefully Bunti can like connect with him and see if he can bring him to one of these chats so that he can explain. I had lunch with him before, and he seems to be able to explain it quite eloquently. Although I did not really dig deeper because we were having lunch in a group. But it seems to be quite convincing the way he's talking about it. So let's see if we can get him on.
Yep, we'll do that. But I will definitely need a YCX. He's the one that have all these critical questions on all these things. Okay, I think that's interesting. Let's move on to the next question. Thanks for your advice on Russia stock last week. EU and HK got big drop on Friday. Any good opportunities there? And anyone give any advice on Russia stock? I don't remember. Have I say anything on this? I also don't remember. But come back to this EU HK big drop. I'll answer first, and then let's move around, see anyone has any comment. I generally don't observe market like weekly basis and then see, wow, if there's a big drop, then there will be an opportunity, and I will just invest in. Because if there's any good opportunities, right, I mean, companies that I like, right, usually I will have some exposure already. You know, for example, like all this Snowflake, right, already have like a couple of shares there just to make sure that if the price drop a lot, then it will show on my brokerage account, and then I can assess whether it's a good opportunity. So let's say for EU and HK, I don't have that many stocks. EU, maybe I have like ASML, right? HK, I have Tencent. So I don't see like a big drop, at least for the names that I hold. I think I'm still watching them, but I wouldn't, I mean, for my style, right, I wouldn't like just look around and see which stock drop a lot and then I will buy in, right? Because I'm not a trader, right? But let's move around, see anyone else have any like opportunities or any companies that you are watching closely that you think is good opportunity because of the drop. Anyone else want to share? Don't just confine to the EU and HK. Let's say if for US, you can also share. Anyone? No good opportunity to share, or not cheap enough? Still waiting for it to drop further. Okay, if not, then we just pass. Let's move on. See anyone else ask question with name? Okay, no. Then go back to the first one. Let me read out the questions. C still can buy. Lost money on Alibaba, rotated to C, then lost even more money. E-commerce is rubbish. Okay, I think it's the same friend again that's asking these questions. But come back to C Limited. Let me comment a bit first on C Limited. I think the recent share price drop is also because of the gaming, right? The gaming result is not that good. That's one thing. And then they have some problem with, India, where they ban their games. And then there's also, and that ban actually happened in first quarter. It hasn't shown in the financial statement yet, right? So I think all this negative news, negative sentiment, all hit the companies at once, right? So I think in terms of the drop, it's quite scary if you look at the top to bottoms, right? I think they by now they already dropped like, I don't know, maybe it's close to 70%, right? But for me, I would just say that it's not to the extent that it's crazy that cheap, because I try to do some DCF myself. I think that it could be in the range of fairly value or maybe slightly cheaper, but definitely not to the level of crazily cheap. Doesn't make sense, that kind of level. So that's my sense on this company. And for Alibaba, I think we mentioned many times already, it is considered cheap for sure, but the problem of this crackdown from the government is still there, right? So I think that's something that is, you need to be able to comfortable with the regulatory environment in order to invest in Alibaba. If not, you will already invest in it because of the attractiveness of valuation. So I think that's comment from me. I just want to look around, see anyone want to comment on these two companies.
I think C, right, current market caps are 54 billion, right? So the common line of thought among all these growth companies with no profit is that they could be profitable anytime they want if they control their costs. So if you look at I think I had a glance with the latest earnings, and if they control their costs, really, they probably will earn about 2 billion a year, and that will mean that it's a multiple of 27. Well, obviously growth comes into play, but at 27 times earnings, it's not as great as a deal when you consider another problem company like Facebook. Problem company as in company having problems. So I think if I'm a risk taker in that, I allocate a certain amount of my portfolio to these kind of risky companies. in terms of valuation, I'll pick Facebook better than C.
So how do you come up with this 2 billion?
If you look at the operating costs, right, I need to bring back up the earnings report. I think the cost of the full year cost is about 3 billion. If you take a look at the losses they make, it's about 1 billion, right? Whole year. So Aga is about 2 billion. Even if they were to like reduce costs dramatically, and maybe I think just read the transcript that Forrest said that their e-commerce will be cash flow positive next year or something like that, right? So it's just a brief estimate. So even if it's earning at $2 billion, it's still 27 times earnings. That's to me. Obviously, it's not very good mathematically, not very sound, but it's just an estimate.
Yeah, because for me, I would think that even if you cut significantly in terms of the expenses, right, probably not going to turn profitable and with that magnitude. Because I'm thinking, because they're still growing very fast, right? So given today's revenue level, it's very hard. But let's say if you let them to grow another 3 or 5 years, right, where their revenue is a lot larger compared to today, even if they stop with the crazy expansion, right, they will still grow at a very high rate. And then with that higher, like 5 years latest revenues, right, then with some proper cost control, they bring it to profitable, then I think it's easier to justify rather than looking at today's numbers now. Because I recall their revenue is also still very small, let's say, as compared to other e-commerce business now. They're still growing fast, like they're still small now. Anyone else invest in C or Alibaba want to give any comment on this? Okay, if not, we just move on. Will CCP further ease interest rate based on its current weak Hong Kong market outlook? Probability of it now. Any comment on this? Okay, then I'll just give a quick comment now. I think CCP won't act based on the Hong Kong market. You know, when all these governments, right, they're all managing the economy, and then they will play around with the interest rate and the liquidity of the market. These are all very common. US is also like that. China is also like that. These are, in general, is true. But they won't specifically manage the stock market. So if you look at the Hong Kong stock market, they are very red, right? Like very weak, right? They won't manage that, but they will manage the economy. So the things that you want to watch out for is not the stock market. You want to watch out for the economic indicators, for example, like the GDP, the employment numbers, the inflation numbers. These are the things that you should monitor, and not the stock market. Because if let's say that their employment looks good, right, and the GDP still looks good, right, still in line with the expectation, right, and market, because of some specific reason, sentiment is bad, continue to drop, right, it could keep on dropping. So there's not a clear link between the government action with the stock market. So I think that's the only point that I want to make. With regards to their stance with this interest rate, I don't have an insight. I know they are more towards the easing side, but the economy is not very, very bad to the extent that they need to like trigger a lot more easing. At least that's the impression that I have. And it's not updated, by the way, so I don't want to comment too much. Okay.
Yeah. Hi guys. I have a question. Okay, when you guys look at all these high growth counters, right? Okay. So do you guys assume that it's gonna grow forever, or do you guys assume that one fine day, the EPS is going to plateau, and because of that plateau, you guys have a end game PE, like, okay, at the end of the day, after the EPS grows, it's going to plateau, and the PE will be, I don't know, 10 or something like that. Is there an end game PE?
Okay. I'll share my approach first and then see others have any opinions on this. Okay. In general, right, for growth companies that without earnings, it's very hard to come up with valuation numbers because, you know, they can, let's say take C Limited as example, right? They can grow at, let's say, 60, 80% for don't know how many years, right? For sure, growth will come down because if you assume 60% growth for like 15 years, right, they actually can become like 10x of Apple market value, you know. So it doesn't make sense to grow that kind of level because they will become larger than the entire market itself, right? So you need to account for that. But we can look at their past growth and then you can extrapolate a bit, but you need to account for the growth will slow down. And when I say growth, I mean the top line growth, the revenue growth first. So let's say see 60%, you might want to assume, let's say 40% in coming year, and then 30% in coming year, and then 20% in another year. And how fast it will come down, right? I would say very, very hard to guess one because we are all wrong one when come up with this kind of guessing because growth, right? It could drop very fast. And it could also sustain at high level for very long. You can bring out different case study, for example, like Amazon or this past growth, past companies that have track record, right? There are many successful companies. There are also many companies that fail along the way, right? So very hard to guess. It's all really up to the dynamic of the sector and then how they execute it. A lot of factors can be in place, but just bear in mind that you have to come up with your own numbers and very hard to guess this type of things. So first you have this growth rate that taper down, and then next thing you want to guess what will be the margin, right? And then there's gross margin, there's net margin. This is also another layer that is very hard to guess. But what we want to see is that, let's say they start from a negative margin now. It could be like negative 50%, right? You could say, okay, with some assumption on fixed costs or variable costs, they could go up to negative 30%, negative 10%, and then go up to 10%, and so on and so forth, right? Then that one is also guessing because it's very hard. Every company will say, we can flip a switch and then we become profitable. Even C Limited, they make that kind of statement. And then you just watch moving forward 1 or 2 years to see whether they can make it or not. Because it might not be as easy as it sounds. So that's my comment. So with that percentage of profit margin, right, you after, let's say you do a 5-year projection, it becomes like a 10 or 15% kind of profit margin. And then from there, you already have a positive margin onwards, and then you can slap a PE on that margin for the terminal value, and then you can discount whole thing back, right? So I think this is a very a generic kind of way for me personally. I use this kind of level to do analysis, and then I can do a positive and some bull case and bear case, right? But usually what ends up is a range that is very big. For example, like C Limited, my range, right, is between 50 to 300. This is like six times between the bear case and the bull case, right? So what it means is that range can be very big. That's also why even if the price drop by 20%, I won't call it cheap, because my cheap is like they have to drop to $40, $30, then only I will say it's very, very cheap, And usually if they drop to that kind of level, there's a lot more negative news that you want to put it into the DCF, right? Then that time the cheap could be like $10 or $20. So it's very hard to gauge for growth companies. So usually what I will anchor it back is like, okay, come back to like stuff that Gavin mentioned, right? Like the total addressable is still very big, and then the quality of the business is very good. The quality of management is very good. These kind of things you still can anchor it because you can get some qualitative factors, right? So it's a bit like cannot anchor to the valuations for growth companies. Very, very hard. That's my opinion. I'll stop here just to hear any other opinion.
Okay. Okay. Because I was looking at C and Baba. I know they're not exactly the same thing, but okay. Correct me if I'm wrong. But C at the moment is not making any money yet, right? They are not profitable yet, right? Am I
not
right?
profitable? Yeah.
Okay. Then whereas when I look at Baba, okay, the PE right now is around 10. So I'm just thinking, okay, let's say for Baba, I assume that there's no growth. Okay, I assume that I just fix the PE at 10. Then isn't it already very how shall I put it? There is less risk as compared to C, where there's a lot of expectation. You know, like C has to grow so much. You know, whereas Baba is even if there's no growth for Baba, I'm just getting it at PE 10 already, which is relatively low lah compared to all the other tech companies. So isn't that less risky?
Yeah, I think from this, if you just look at the number itself, right, for sure, Alibaba is much cheaper than C Limited. And C, because of you just look at DCF, you will know, like, okay, what was the growth rate that I need to put in order for the intrinsic value to equals to today's price. And you will notice that if you put a growth rate of, let's say, like 30%, right, you will never reach the today's price, even after this 70% drop, you know. So for sure, there's still a lot of expectation has been priced into the companies for C Limited. So that's I will agree with the comment that you just made. But come back to Alibaba, I will say that you can say that I'm very conservative with like 0% growth, right? But if you want to make a bear case for Alibaba, you will actually ask, like, could they actually sustain today's profit margin or not? Because the government already come out and make a lot of all this, come up with a lot of guidance to guide the industry to certain direction towards the common prosperity, right? So you might want to ask yourself, like, okay, I don't know what's the margin that they have today, right? Could it be like 10%, right? Is 10% enough for the government, right? Because is there a possibility that the government actually want to guide them towards 5%, right? And how long would it take for 10% to hit 5%, And will 5% be enough or not if you're coming from a government perspective, right? And if they want the country to be successful, do they actually want Alibaba to be successful, or do they actually want some other companies that should take over Alibaba place and become successful? You know, this kind of question you really need to ask, because you can always come up with bear cases that say actually even with current pricing it's still expensive. Because I might want to come up with a base case that to say actually Alibaba revenue earnings will drop by 5 to 10% every year from now, and they will actually until their size is 1/3 of today's size. I mean, this is sound crazy, stupid, right? But with government that doing all this guidance that guide the commissions to 0%, not zero lah, they guide it to become lower to help out with the society. The question is always like how much help that they need to help, you know. To me, I don't have a good answer lah. That's why I'll just put it there lah. I know it sounds very stupid to say these kind of things, but I think people who stay away, they will just continuously to stay away when the government sounds like any profit sounds like become a crime, you know. So that's just a very bad statement. So I'll just stop here.
Understand. Thanks for your insight. Would you be surprised if the EPS were to drop for Alibaba? Like, do you think there is a high possibility for that to happen, or do you think
it's already happened, right? Yeah, already happened. You look at the most recent earnings, the earnings already dropped, and the question is why, right? I also don't know why the earnings has dropped. Given that if the management is still good management, revenue is growing, right? Earnings shouldn't drop, even if after you adjust out all the one-off items, right? For example, all the fines, all these things you adjust out, earnings shouldn't drop, right? But it dropped in the most recent quarter. I haven't figured out the true reason, but it's something worth to ask, right? Why it dropped, right?
I see. Okay, thank you very much. Thanks.
Okay, thanks for the questions. Actually, Chiang is here. I just want to ask, you have any comment? I know I sound very bearish on that. I just want to make the argument that there's always a bear case and there's always a bull case for every company. It's not like I'm thinking Alibaba is dying. But Chiang is here. I just want to hear any comment from you.
Oh, hello. Actually, the earnings drop, I think because they have been recently investing more and more, like putting more money into all those new initiatives. And then also the Chinese economy is not doing very well. And then Alibaba is mostly depend on the Chinese economy, right? So like now should be like this, right? It's just because Alibaba is quite dependent, like most of their income is from China.
Yep. So come back to the competitions, economy, and come up with
it's like
initiatives.
A lot of issues, but I think like when the Chinese economy recover and then the consumption and everything, then it should be back to increasing earnings. Because they are now in the new, like their new initiatives, like beginning level, so a lot of heavy investment. But they say they already achieved the user base that they want, so now it's just optimizing the cost. So it should be better going forward, sir.
Okay.
So I think
thanks for the comment. Yeah. Because I was thinking, like, let's say if the revenue, because of the economy is bad, revenue drop, right? Then earnings drop. To me, that is something that is understandable. But let's say revenue is increasing, which means the economy is not that bad, right? But then the next question is like, what's the expenses they spend on, right? So I think this one definitely needs some digging to understand. Okay, let's for that questions, let's move on. I find it sad that many focus on US or Hong Kong stocks but ignore SG stocks. For your information, STI is positive while DJIA, Nasdaq, HSI are in deep red. Can we discuss some SG stocks? Wow, I think this is very good questions there. But I just want to say, in the group, right, there isn't any. Actually, try to make the discussion as broad as possible. Any companies we can discuss. It could be Singapore stocks, it could be US or Hong Kong's, right? But I actually want to like throw it back to all the members, right? Actually, if you are interested with SG stocks, I would just request that you come up with some pointers, right? It doesn't have to be like long posts, right? You just come up with some pointers to say, okay, actually, I'm looking at this company. What's the bullish point? What's the bearish points? And then a simple DCF or anything like that, right? Just to say that, okay, I do see that this company is a good investment. What do you guys think? I think if you kickstart with this kind of post, right? Then people will respond and then we can discuss, right? It's not like I'm banning anyone to discuss Singapore stocks, right? So it really depends on the members in the group now. So that's just my comment on this. Anyone else want to discuss on this?
Personally, there's a lot of cheap companies in SGX also, but the liquidity is really very bad. So if you have a decent amount of money to invest, you have to really buy small amounts all the time, and it's very unappealing. But for Hong Kong, there are also that kind of very cheap, statistically cheap companies, which will be very interested to a cheapo like me. But the liquidity is so much higher, so it's more appealing when we talk about Hong Kong markets.
Yeah, I do understand, like, okay, different markets, different situation, liquidity, valuation, all these are very different. And then the government is very different, right? So you have different situations. But what I try to bring out is that what companies that we discuss in the stocks depends on the person who actually come up with ideas and come up with talking points to discuss about. For example, if you want to talk more about Singapore stocks, maybe you can ask about these questions. What do you think about Keppel? What do you think about Singtel? What do you think about SIA? I mean, questions, if you just raise question, it might spark some discussion. But of course, people might just ask you, right? If you ask, what do you think about SIA? People might ask you back, like, what do you think about it, right? Then you might want to like have some thought process, think about it first, and then share with us your view on the companies. Then from there, others will give more comments, right? Because I think that's how we carry out this kind of discussions. For example, like Billions Achiever, she mentioned that, okay, this conversation with a friend, and then there's a couple of points, and then we can further discuss on those points, right? Because if there's no one to share this first couple of pointers, right, then there is no such discussion, right? Nobody mentioned about these companies, right? Nobody kickstarted. So I think the burdens fall on the person who asking this question. You might want to share your view first on the Singapore companies that you are looking at. Then we start discuss from there. Okay, let's move on. What is your personal DCA strategy? Every 10% drop by X% or question mark? Just look around first. I think Maximus has some view on this. Are you able to speak now? You want to give your comment on this? Maybe not available. Others, anyone want to share your DCA strategy? This is interesting. Okay, so quiet. If no point, I'll just share mine. But I shared mine before, right? So I keep it short now. For me, just every month put in money into the brokerage, and then I'll just from time to time I'll just buy into companies that I'm bullish on. So you won't see like a consistent buy like exactly the same amount every month. You won't see that, but more or less you will see purchases made over time. So that's one. And then this every percentage drop, I don't use this because I don't have a cash pile. So that's the main reason. I think this is like every 10% drop by X%. These are for people who have a cash pile, right? For example, like you have 100,000 and then you want to deploy it, but you want to deploy it only if the price level drop to certain predetermined levels, right? Then you can come up with a plan beforehand. And then once it drops, right, then you just execute like a robot, right? So I think this one makes sense, provided if you already have the cash pile. Like for me, I don't have, I've always fully invested, right? Even now, I still have close to $10,000 in margin. So I'm always fully invested. So it doesn't make sense for me to keep racking up. If the stock price drop, I keep on margin more, right? It doesn't make sense. Too risky for me. Anyone else want to comment on this? If not, we move on.
Yeah, hi. Just to chime in, right? So basically, I have the same strategy as you. I use my payday to sort of like DCA, but before that, I will sort of calculate 30% cash and CPF, and 70% will go into equities. So every time I will just use my salary to sort of rebalance, so that takes care of the rebalancing problem that is suggested in this question.
Thanks for the comment. So basically just DCA across time rather than buying based on the price level, right?
And also basically because right now the markets are getting hit. So if you rebalance it using your salary to 30-70, you will sort of put in more cash into equities for now.
Yeah. Okay, I think that one also makes sense. There's an automatic like invest more when the stock price drop. Yeah, that's built into your method. Yeah.
So on a bull market, you will retain more cash. So more bullets to come in on a rainy day like this.
Yeah, I think that's a very sound approach. Okay, let's move on. I think we have still a list of questions. Okay, let's move on for another 10 or 15 minutes. Listen to gurus and concentrated in a few stocks. Now have many short dip in the money puts on C. Keep falling, margin call. What's best way to manage? Is this question from Nick? I was curious. Person asking this question, are you here? Maybe you can unmute and give a bit more background on the situation that you are facing. Okay, no. Anyone else want to comment on this? It sounds like a very tough problem, right? You know, you see, I also looking at C price keep dropping, and then margin call some more. Sounds like very tough. Right? Okay, no comment. I'll just comment first. If I'm in these situations, right, it's because I'm just interpret on what's happening here. So you might sold a couple of puts option, and then now because the price has dropped below the strike price, you have a huge liability here, right? You can roll forward your puts, but then it will affect your the level between your current level versus the level that you are margin call, right? And then you also mentioned that you already experienced margin call. I think for me, right, I think this kind of situation, the worst thing is that the margin call, because what happened with margin call is that whenever the price drop, right, it will always sell at the worst possible times, right? So if you are already in these situations, right, you need to accept that either you pump in more money into your account. If not, you have to de-risk, right? And by de-risk, what I mean is that if you have a put option, you might want to like actually reduce it or roll it in such a way that it will reduce your risk exposure. And then if you have a cash position, you might want to sell it, right? So there's no choice, because even if you don't want to sell, the broker will sell for you. This is not a good opportunity for you to just keep on increasing the risk exposure. Doesn't matter how cheap the price is, because you are not in the control on holding the stocks. The broker will sell on your behalf. So no choice, you have to de-risk. That's the things. So, but actually, provided that if you have income and then you have saving, you put on money into your brokerage on every month, right? If you just do nothing by right, your leverage ratio will reduce over time, right? So that's why if you keep on facing this problem, I think there must be like you are keeping too much risk exposure on your book beforehand. So I think you need to be very careful with managing all these margin liquidations. This is not a position that you want to be in. That's why I will always say you can enable the margin, take a 1.05x on the money that you have. That one is fine, right? But please allow for a huge margin between your current level versus a level that you will get a margin call. It's not fun to get into these situations, because it could be that after you just de-risk, right, then the market just rebound, and then you see you are right in terms of your thesis on the company, and even so you will lose money, right? It's not a fun position or a good position to be in. Be really, really careful on the margin management. I got no other good suggestion. I think this is a very tough situation for you. So just empathy with you. Okay. Others, anyone want to comment on this? If no, we move on. Next one. I have an education loan to pay off in 2024. Given that markets have dropped so much, should I whack into the market first, since still got more than 1 year plus? Okay, I need to digest a bit first on the education loan. Anyone know how education loan works? Is it like you need to pay every month, in this case for the next 2 to 3 years? Is that how it works?
I think quite different depending on the loan. But I know some is the day you graduate, then the loan will start. Like you can start paying off the day you graduate. Then some is monthly. But yeah, it depends on we definitely need a lot of context for this one.
Oh, so what it means here is that, okay, I only need to start paying from 2024. And
can assume yes, so. Not enough context to work for this.
Yeah.
I feel like he has to pay off by 2024. That's how he did it.
Okay. Yeah, I'll just stop from comment anything, because I don't understand these questions. I don't know how the loans work and how much cash on hand, and then what's the like what's the obligations. I'll pass on this. Okay, if no comment on this, let's move on. Advice to new investor with 100,000 spare cash, no need to use for 20 years given the current market situation. Lump sum now or wait or monthly DCA into VWRA. Okay, I think this is a timing questions, because I think he's already made up the mind to go passive, which is going VWRA, right? I think for me personally, I would just whack 50,000 right away, like 50,000 lump sum, and then I will try to, like, let's say like two or 3,000 every month moving forward. And hopefully with the cash saving that I have, right, that 2,000 or 3,000 moving forward will be something that is more sustainable. So you see 50,000 in, right? Another 50,000, if I split it, become 2,000, that means I can have 25 months, right? And then couple it with the saving that I have, this 2K per month could be something that is sustainable for years ahead, right? So I'll try to do that. So it's a combination of lump sum and also DCA. That's just me. I would like to, interested to hear like what other approach or that you guys have. Just see anyone want to chime in on this.
I mean, not that I have a crystal ball, but I think given how the world is developing right now and how high the VIX is, I think maybe wait for the end of the year, not end of the year, end of the month, for Fed to sort of raise their hikes and see how the inflation take into the February numbers.
Okay. So there is a bit of tactical view there. Just want to wait and see approach. I think.
Yeah, I would suggest wait for 2 to 3 more weeks.
Yeah, I think on the Fed one, I think that's one also quite interesting. I don't think that's very in terms of March 25 bips. I think that's given already. Not much uncertainty there, but the next uncertainty is actually how they're going to pare down their balance sheet. I'm quite curious because in the couple of minutes in the recent past, right, they are actually trying to guide or try to hint to the market that the runoff will be quite fast. So it might impact the bond market, and then the bond market might impact the stock market. So that's my concern. So that's a huge uncertainty. But in terms of like whether it's 25 basis point or 50, I think there's a lot of certainty already. Okay, let's move on. We want to answer this question. Gavin, Path, how? UiPath. I remember you are into Path too, dropped more than 50% from all-time high. And also far from IPO price. Still good company? Yeah, Gavin, this is your question.
Fundamentals look fine. I think from the previous time I talked about it until now, we just ignore share price. Nothing bad has really happened. For me, I'm always fundamentals first, and especially qualitative comes first rather than quantitative. And like from the past times I've talked about it, I think it's quite obvious that I always look at company product first, company management first, rather than any form of valuation. So company-wise is good. Price, not so nice. But it's still, fundamentals-wise is still good from my viewpoint.
Yeah, I think this one, all this cash price, okay, there's a macro. I think the share price for all these companies, it's really, there's some, how to say, the environment is really, the sentiment is very bad for this type of companies. So that's why the price has dropped a lot. But I'm not aware of there's any negative news with regards to the fundamentals. So sometimes we really need to split the fundamentals and also the price movement because we are not traders here, right? So please keep in mind.
I think for those who have weaker conviction, you always peg your understanding or your belief to the share price. So share price up means it's good, then share price down means it's bad. But yeah, like you said, it's very important that you need to separate out the two. Share price is share price, value is value, right? It's like if you go to a market today and then you see the Wagyu beef is $10, then tomorrow you see it's $5. Does it mean the Wagyu beef is less tastier or what? Not necessarily, right? It could just be on sale or some other reason. So it's not always correlated. It could be, but it's not always the case. Yeah.
Yep.
I would think that if you want to know if these kind of companies are cheap or not, you need to look at the insider actions. So for the Wagyu beef analogy, right? If you see the butcher or the guy selling the Wagyu beef, he decided to cook the Wagyu beef and eat it itself. Maybe the beef is too cheap. You know what I mean?
That's a very good follow-up. But yeah, that's very true also. Insider trading is something to also look at. But when you look at Palantir and then talk about insider trading, then there's a slight difference also. So case-by-case basis.
Yeah, but the Palantir one is not, the story has not concluded yet, so anything can happen.
Okay, I think let's continue the discussion. But I think now it's 12:30. I'm conscious of the time. We'll just spend like 5 more minutes on this. But there's a couple of questions that I want to give like very quick answer lah. So like this example, number 2 questions. I'm 100% vested. What should I do, right? So my question is like just do nothing. If you're already fully invested. If you have saving, then you can continue to put your cash into the markets, right? But if you don't have cash saving, then just do nothing. I think whenever price movement, right, price move significantly, there's always this urge to do something, right? But sometimes just do nothing is the best way, right? So I think I just want to quickly comment on this. And this second question, how to reach financial freedom if portfolio are growth stocks that doesn't pay dividends? I think this one you might want to split into 2 phases, right? The first phase is the accumulations. You can accumulate your portfolio in growth stocks, in index, in whatever, right? But you start to accumulate your portfolio in, let's say, growth stocks. That doesn't mean that you have to retire with growth stocks. You can always transition it to some other companies that is more mature, pay dividends, so that it's easier for you to manage your expenses and cash flow and so on, right? So I think this is like don't have to fixated to certain way, like from now till like entire portfolio run off. And even so, right, if you say, okay, I'm still want to bullish on growth stocks, companies that doesn't pay dividends, you can always sell your holdings and use the proceeds to fund your expenses in your retirement, right? So I think all in all, if you have a very decent portfolio, for example, if you have like 2 or 3 millions portfolio and your yearly expenses, if let's say just only like 30 or 40,000, right? You only need to like sell a small percentage of your portfolio and then you can fund your expenses for 1 or 2 years. If you are already in that situation, retirement is not a problem. Retirement is a problem for those who don't have enough assets. It's not because their portfolio in growth stocks, hence they cannot retire, you know. So I think we need to split out this, like what was the composition of the companies that you're holding versus the size and the expense level that you have. So that's just a quick comment from me. Yeah, I think that's 2 comments I want to quickly make first. The other questions, is there any questions? You guys here also can scroll around. Any question you want to quickly comment on, you can just unmute and let me know. We have list of questions. We won't go through all of them.
There's some guy asking about this Hong Kong counter 1830. If you look at right at the bottom, the recent question, any Googles into 1830. Yeah, I think that stock is a stock I used to own. So maybe the person who asked this question could message me. Yeah, this is the one. Yeah. Yeah. So just message me on Telegram. Yeah, because I have some understanding of this stock.
Okay. Is there any other, I mean, for those who are here, right, you can let me know, just unmute and let me know which question you guys want to talk about. We need to be more selective. Time running out. I think this one is interesting. Any famous value investor in Singapore, those with track record one, and don't tell me Ho Ching. I think this is, and anyone that you guys are following can, give some names.
The most famous one that we all know is Master Leong.
True.
But there's also Peter Lim, but that he doesn't really have a track record. He only has that one stock that rose him to fame. It's like Chicken Genius, one stock all the way up. But he's also an interesting value investor.
I think if you want to talk about long-term value investors, there's this guy called that runs Target Asset Management. Yeah, his record is about maybe 18 to 20 per annum annualized, so he's not too bad. But I don't think you can easily contact that person. He's pretty old. His funds is not open to public. Yeah. He has I think he has pretty much very frequent quarterly letters being updated to the site, but you can't log in unless you are a client. So there's no easy way to learn from him.
Yeah, thanks.
Hi, Bunti. I have one here. I have two actually. The first one, of course, is our Bunti, and the second one, actually, I think maybe less popular, and I think some of us here may not really like him, but I think he has credibility because he has shown his portfolio and can be checked publicly on YouTube. And it's actually Adam Kula. I do follow him, and his explanation always very succinct and clear. And his track record, I think for the past 3-4 years, you can find on his YouTube channel, he showed his portfolio. And so I think that part itself, undeniable, numbers is there. Just that when you watch him, need to remove a bit of our earlier biasness to him. Then I think looking at his numbers make quite a lot of sense. Yep.
Yeah, but mine one is I follow QQQ. So we all following each other. Okay, I think let's move on. I think there's one more question. This is also interesting. How long will it take for market to recover when all these bad incidents like war and rate hikes are over? Yeah, I don't know how long you are in the markets, right? But I can share with you, these things can drag on. Could be it like war, be it interest rate hike, or let's say if after interest rate hike we have a recession, right? And then market can continue to go down, right? These things, it could drag for 2 years, 3 years, 4 years. It is possible. So I mean, we all invest, right? Don't invest with the expectation that market will go up, like let's say like 4 out of 5 years, right? We could have a negative year this year, then negative year for the next 3 years. This is all possible. But as long as the fundamental is still there, and you are not in a position to say that, okay, you are now 65 years old and you need to liquidate the portfolio to fund your expenses, right? If you are not belong to that group, right, that you are still young, you still have saving, you're still investing, right? I think period like this, market keep on dropping, is actually the best period to invest, because we are not traders, right? We don't chase the market, right? All your investment, like by the time that you retire, which could be like 20 years or 30 years down the road, right? All the best investment will be made during the period where the stock keep on dropping one. Because once it drop, there will be traders who will get out, right? Traders will say, okay, falling knife, I get out, right? This kind of situation, once it happen, right? The share price will be very, very cheap, and then you just need to accumulate and you will do well over time. So, but when it comes to expectation, especially short-term expectation, 1 or 2 years or 3 years, this kind of horizon, right? Be prepared to see a negative returns for 3-5 years. Don't say it won't happen. So if you already have that expectation, right, then I think investing is just like much easier, because you know, right, it drops, then fundamentals still good. I just accumulate, right? We want to buy good stuff and we want to buy cheap, right? And we don't want to see the price drop. I mean, what kind of logic is this, right? For sure, we want to see them become cheaper, right? Yeah. Okay. I think let's see. Do you guys want to cover one or two more questions? If not, we'll just stop here. Okay. I just look around, see any other questions that you guys want to discuss. If not, we close the call. Okay. Because of the time constraint, it's 12:40 now. I think it's better to close the call. So if there's any questions that you're interested to discuss, please raise it in the group, and then we can continue to discuss there. Okay. Thanks a lot to everyone here, especially those who commented, help answering the questions, especially Gavin, Boonsong, Kelvin, Yang. Okay. Thanks a lot for joining, and let's catch up again. I'll end the call here. Bye-bye.
Bye-bye.
Thanks. Bye.